Welcome to Investors Insights, where today's topic is answering client questions. We greatly appreciate the feedback and engagement we get from clients and viewers of our vlog every week. And we want to take this opportunity in this week's vlog to answer a few questions that have been asked by viewers wanting further information on certain topics that we've covered in the past 2 weeks. And so, Adam, I want to start with you. So you always get complimented on your technical analysis that you provide every week. And you've had some viewers call and email in about asking for certain examples of exactly how we use technical analysis. And I know you've got an example here, so go ahead.
I appreciate it, Bobby. And to your point, so often we talk about resistance and support levels. Recently, I've been asked how we arrived to those numbers. So one of the main things that we look at are moving day averages of the S&P 500. Some in particular are the 50-day, the 100-day, and 200-day. So recently, we talked about the S&P approaching the 200-day moving day average. We saw this happen in the last couple of weeks. We've already seen the S&P 500 trade over both the 50-day moving day average as well as the 100-day moving day average. That starts to build a certain momentum in the markets that we look at and we can capture. In the last couple of weeks, we saw it almost hit the 200-day moving average, but then move directly back down. That gives us indication whether we need to go into certain positions or whether we need to sell certain positions. So overall, it gives us a good indication of that certain momentum in the markets and where we're headed in the next couple to few months, all the way out to the end of the year. It's also important to keep in mind that those days are actually captured on trading days. So when you hear 200 days, that is days of the week, not including weekends and holidays. So I hope that gives you a little bit of insight to the question that we received.
Thanks, Adam. And Ty, last week you covered corporate earnings, and we had a viewer ask about how corporate earnings how performed in the second quarter compared to historical earnings for previous quarters. So talk about that from a historical standpoint.
Yeah, so like you said, I hit on last week, 8 of the 10 sectors improved on corporate earnings. They exceeded expectations. But was that just because expectations were low, or are we really in a good spot here? And as you can see on this chart, the average for corporate earning beats are 66%. Right now, we're hovering around that 76% level. And as you can see, it kind of flattened out from the first quarter of this year and even up a little bit from fourth quarter last year. So that's a good sign of, you hear a lot of this talk about a lot of the negatives, but so far corporate earnings have hung in there quite well.
Yeah, so from historical standard, corporate earnings for second quarter of this year are performing better. And so that's great to see for the market. And then we also continue to get a lot of questions about the housing market and what impact higher rates are having. And right now, we're definitely seeing a slowdown across housing, as we saw total U.S. home sales were down 12.6% in July. 12.6% in 1 month. That's a big 1 month drop. And as you can see in this chart, existing home sales, new home sales, and the housing index have all seen a steep drop. So we're watching housing carefully to see what impact housing could have on the overall economy, as we're seeing a definite slowdown in the housing sector, and then also what impact it's having on the market. So thank you for the questions we continue to get from our weekly vlogs. Please keep them coming. Email us with questions, call us with questions. We really appreciate the engagement. So have a great week, and call us if you have any questions. Thanks so much.